Welcome to our webinar on the smart way to global investing, international markets, AI, benchmarks, and beyond, brought to you by National Bank Direct Brokerage. This hour-long webinar, hosted by Bobby Argytis, Senior Investment Specialist, with our guest Carl Dussault, founder and CEOs of Evovest, will discuss international investing and the benefits of diversification. We would like to thank you for your interest in this topic.
Let's begin. So off the bat, thank you everyone for coming. So today's webinar topic is the smart way to global investing. We'll be talking about international markets. Carl was talking about specifically about some AI benchmarks and beyond. So I just wanted to obviously start off our little disclaimer. The information that's presented today in this webinar is for information purposes only. It's not a recommendation, or solicitation to buy or sell a product. Obviously, as self-directed investors, you're in charge of what happens in your portfolios. But the information here is actually, is as far as I'm concerned, is actually very, very interesting. We're talking about global investing, but in reality, this really comes back down to diversification, right? We've been told diversification is very important. Don't put all your eggs in one basket. So this is just I guess it's a continuation of that topic. And one of the things that comes out is Canadian investors, they have a home bias, but in reality, everyone has a home bias. I was actually looking up this and about a few weeks ago, and if we look up home bias and you put Canada, you'll have articles, right? But if you write down the word home bias and you write down other countries, whether they're in Europe, in Asia, South America, they add their own articles. So people like investing, with stuff that they know. Now, to help us along in our presentation, I've got Carl Dussault, who's a founder and CEO of Evovest, and I'd like to hand off the presentation to him to continue. But Carl, I'd appreciate, if you could take just a few moments just to talk about yourself and Evovest, if that's all right.
Yeah, thanks, Bobby. So I think the goal today is, as you mentioned, is to go through a bit of the basics of international market and the underlying benchmark and how to tie that up to the diversification aspect of building our own portfolios. But to start a bit about myself, I've been in the industry for about 15 years, mainly in portfolio management role. Institutional, high net worth on that side as well. But I founded Evovest about 7 years ago. Essentially, our mission is to look at how to use technology, which is in this case is AI, with the fundamental investment knowledge that I had to essentially systematize the way investment management is done. From that perspective, just about who we are. We are emerging portfolio management firm, a small team of 8, and we eliminate biases into quantitative finance, and that's been shown with a proven track record, which is not the topic of today, but we do invest internationally, and for us, like the choice of the benchmark and why it brings diversification is those are topics that we do care. So this is the knowledge I want to transfer to you today. So if we go from a Canadian perspective for international market, I think one of the key things is if Bobby, you can go to the other slide already, is when we looked at the TSX as an example, it's highly concentrated in financial and energy. As you may see here, it's about 50% of the stock market is within 2 sectors, so which essentially are the banks in Canada and also the energy companies. And then you have a lot of industrial materials. So you don't have a lot of all the others, like the staples, utilities, discretionary, communication, real estate, and healthcare, which in a sound portfolios, they should bring a bit of diversification. So when Bobby talked about the home bias, this is a really good example that if you choose to buy the TSX with one of the ETF out there, it could be, in a sense, yes, it brings you diversification, but it's not a complete way of being diversified. So this is why we want to discuss international market with you today. If we move to the next slide, I think like to give you a bit of what are the name behind those sectors. In that case, you may recognize which the bigger name in Canada, most of them are the banks, with Royal Bank being 6.5% of that indices. So those are big numbers. So when you buy that benchmark or the TSX or the ETF, you've been exposed to owning Royal Bank of Canada to 6.5% of your portfolio, which is a kind of a big thing. So for us, looking away from Canada should bring diversification also from a sector perspective, but also from a name perspective. So the specific risk of each company can be diminished by looking elsewhere than in our country. So as a good example, if we compare first to the US market, so we have a different kind of perspective. And then this is interesting to tie that up to what Bobby told about the own bias. But here, like it's mainly IT. It's 31.3% of the stock market in the US. But if we recall, Canada was like not that much. So from that perspective, if we look at having a diversified portfolio, having some US and some Canada makes a lot of sense because the sector composition are complementary. And if you recall, so energy was one of the biggest in Canada. In the US is like 3.8%. So again, from that perspective, it makes a lot of sense.
If I could just add, Carl, I don't know if you guys picked up on it, but I'll just use one sector as an example. The third biggest in the States is healthcare at just under 12%. If for those of you who like to nitpick, on the Canadian side, I think it showed up as 0.3%. So in essence, this is a sector of the economy that, for all intents and purposes, Canada doesn't really have anything. And if we go back a few years, I think there was that period where there was I think it was Valiant, if memory serves me correct. Yeah. I think it was basically a one stock industry here. Yeah.
Yeah, so this is another problem. So in tech space here in Canada, you have a few names: Shopify, Constellation Software, but the big names that we see every day and that you use every day, Apple, Meta, Google, they are part of the US index. So this is kind of an important aspect as well. As we mentioned here, when we looked at those names, and funny enough, sometimes even if the company looks alike, they might be classified differently. But here, if it's most of them, they are all related to some aspect of technology. Even the Amazon, we understand that you buy stuff, but it's an online platform. Broadcom, they build chips to put in phones and stuff. So, and NVIDIA, we all hear about this this name that is reporting at the end of the day. So it doesn't bring much diversity. Like you have still concentration in the US when you look at it. When we said earlier that the Royal Bank of Canada was 6.5%, but here you have Apple about the same number. So here it's interesting if we look at the MSCI, the rest of the world. So looking at everything that is outside Canada, it brings that diversification from the perspective of IT still there, healthcare, but we don't have much of a energy exposure. So, and you have different companies. So from that perspective, if we just want to have a greater diversification, looking also away from the US is not a bad thing. A lot of companies also operate in the European or Asian market that have different growth or valuation profile, might be interesting for the investor through either ETFs or stock specific. Here, I think the key point of this discussion is to look at what compose those benchmark that can be bought and sold through the ETF, most of ETF markets, as an example, passively. If we move to the other slide, I think one of the key thing as well is, why do we want to look outside Canada? So most of the time, the US, the CAD to USD pairs is really correlated with the price of oil. So if oil demand is high, the Canadian dollar should appreciate against the US. So I think you can see clearly the high correlation in blue and in the dotted red line. So I think you cannot ask for something that is more correlated than that over a small cycle of 3 years. That brings me to the other slide, why currency is important within that spectrum. So should we hedge the international exposure? So if we have an edge in place, so it means that if there's, most of the time from a Canadian perspective, when we observe an economic shock out there, the price of oil will go down. So when the price of oil will go down, also the Canadian dollar will go down. So that means that if you have a dollar of international exposure, this will go up if the price doesn't change. So technically, when you look at it and you say, okay, I just want to have I want to manage my volatility of the portfolio. So you should not hedge from a Canadian perspective. Hedging your currency is not a good thing over a long period of time. As it shows in the table at the bottom of that slide, when we look at it from the perspective of having the Canadian dollar index versus the US dollar index, so the volatility is 3.6% less, which is kind of a substantial amount in terms of volatility. So here, what I wanted to showcase is really from a Canadian perspective, not hedging our international exposure to currency most of the time result into a lower volatility of the portfolio. As a good example that I haven't put in that slide, but if you look at the return in March 2020 of a US exposure in Canadian dollar hedge or unhedged, there's a big difference there. So yeah, that was one of the key things I wanted to highlight, also from a diversification perspective. So in summary, there's 4 points to take into consideration for selecting an investment for the international market. Is one, we have a concentration in the stock market in Canada. There's also this relationship with Canadian dollar and oil that is really high, and that is to be think about when there's hedging need or not. So to be careful with that, how do you choose your international exposure from that hedging perspective? And lastly, there's a lot of other international opportunities that can be achieved for your portfolio in the international market.
Right. Carl, before moving on to the next section, maybe there's a question that came in. I'm tempted to answer it, but I'd rather have you. So in terms of the Canadian Canadian market capitalization, how big is Canada? Like are we 1%, 5%? How big of an impact is our market cap versus the rest of the world?
If I go with the MSCI World, I do think I have the fact sheet in front of me in a few seconds. I will say it's about less than 5%. Canada is 3% of the market cap weighted MSCI World. So to give you a bit of perspective, 70% is in the US. And I would say that Apple and I think now it's Microsoft, NVIDIA, or Apple are all bigger than all the stocks in Canada, to give you a bit of a perspective there. So Canada is like nothing.
Perfect. Thanks.
So the next logical step to discuss, once we say, okay, there's maybe a need for my portfolio to be more diversified and to have an international exposure, but how do I choose that exposure? And understanding benchmark, I feel it's something that we don't spend a lot of time to really look at them and say, okay, what's really the characteristic of this one versus the other? So here, this is what I want to introduce mostly to the crowd today. The basic definition here. Why do we need benchmark in the industry? For the institutional portfolio manager, there's a lot of it's a standard to measure performance. So you'll be evaluated against if you're managing the US portfolio, you might be benchmarked against the S&P 500. If it's a Canadian one, will be the TSX. If it's a global equity, it might be the MSCI World. So it's really that standard of measure. But what it does essentially, normally it's a broad market. It will represent a segment or all of it. And some example that you are all aware probably is the S&P 500, the TSX. But one of the MSCI World that I just mentioned earlier, there's also a components where you have the MSCI World equal weighted. I'll introduce that in a bit, but you have different flavor of benchmark construction. So every time you look at the ETF or the index it tracks, or which benchmark the portfolio manager used to benchmark his performance, this is important to gain an insight into what's the diversification that I get. Is this one I want or something else that I prefer? So exactly to the benchmark and choosing your ETF. So when you look at there's the one that tracks passively, it's super important to make sure that from your perspective, it aligns with your investment goals. I think, Bobby, you probably have a lot of webinar or educational stuff around the importance of defining investment goal and then managing the portfolio in a good standing with those goals, even if you do it yourself. I think it's the basic 101. So those also ETF, it allows for the comparison between the ETF performance of the broad market. If you have a value tilted ETF versus a growth tilted ETF, basically what it means is the underlying benchmark either choose the value index or the value benchmark or the growth benchmark. So sometimes it will appear within the names in the documentation of the ETF, the prospectus, so the fact sheet. So those things are really a good source of information to determine, okay, what am I really getting except the name of this thing? It should be able, with those information, you should be able to understand a lot more the strategy underlying this. And with those information, evaluate either if it's an active ETF, is the manager skills, or it's a passive one, is the tracking error too much versus the underlying benchmark. So I do feel that those four kind of concepts are important for moving to, okay, I want to have a international exposure to, okay, I need to understand what's the benchmark behind that and choosing the ETF. So there's this link that is tied to all those concepts. As I mentioned earlier, there's this MSCI World market cap weighted versus equal weighted. Here I want to introduce what is the difference between those two things. The market cap weighted index, what it will do, it will take all the company with their market cap and weight them by their market cap. So essentially, as we saw earlier, Apple is 6.5% of the S&P 500. Royal Bank is 6.5% of the TSX. But if we put it into the MSCI World, which is the global benchmark, those numbers will change. but it would be again based on their market cap, the weight of their market cap within that index. If you have a small cap stocks that has a 50 million market cap, it will weigh nothing in the index, and some of the large cap index and benchmark won't have any of that name in the investment universe. But comparatively to that, a equal weighted benchmark, what it does, it put the same weights for each company and depending of the size. So meaning that Apple has the same weight has Royal Bank or Metro or Dollarama. It's all the same thing. So it's one over the number of name within that index. So what it does, essentially, it will be beneficial in some ways, depending on some of the aspect, but it could mean that if you have a high concentration risk in some of the indices, it could diminish that concentration risk and increase diversification. So I think here I felt that it was an interesting concept for you guys to be exposed to. But as this example is showcased here, we see that the small, it's 1.1% on each company in that index, that MSCI World Equal Weighted, versus Apple, Microsoft, NVIDIA in the market cap that is much bigger. That was the key aspect I wanted to showcase with that top 10 holdings.
And Carl, out of curiosity, so obviously it's very clear that individual securities. But let's say, for example, if we let's say we're looking at financial services. So let's say the financial services in the market cap weighted world is 15%. Let's assume it's that. In the equal weighted, would it really have a big difference, or or certain sectors drop a lot more?
It changed a bit, but not much. I can to give you a bit of a perspective on that. When we looked at the biggest industry, the biggest sector in the equal weighted is industrial at 18, financial at 17, and IT is at 11. So to give you that perspective, we're moving from kind of a 25% to 11. So it's a different portfolio composition.
Okay.
So when we looked at what are some possible benefit of an equal weighted benchmark, there's really three elements at play here. There's a reduced concentration risk. So if you want to have exposure to the bigger name, often it's easier to have information. It's easier to buy them individually. You can have it's easy to have a passive exposure to those. So the equal weighted benchmark brings you that. It enhances diversification because it spread the investment across company of different various size. So technically, you have a small cap bias, so you have more small cap into your portfolio in your benchmark versus the market cap weight index, and also it offer at that time here today. There's a value play because the company are a bit less expensive in the MSCI World Equal Weighted benchmark. The method of comparing the MSCI World to the equal weighted, I think here it gives a bit of a perspective. So there's period of where some exposure will outperform the others. Like we've heard that market cap weighted indices, they've been outperforming the equal weighted peers for the last 5 to 10 years. It's often there's a revert to the mean phenomenon that can take time, but as you may see in the graph, the blue shaded area, it's when the equal weighted outperform the market cap weighted. And it did happen after the tech bubble last time. So when you are spread across companies, you have less concentration risk. And in that case, as we see today, with the valuation of the NVIDIA of those world that are really higher, it brings a question of, for the next 5 to 10 years, where am I better to be in terms of selecting a benchmark, the market cap weighted or the equal weighted? And also one of the characteristics of the equal weighted is it has a less exposure to the US. So it's more diversified from a geographical perspective as well. And as I mentioned earlier, when you look at the forward price earning, you have a bit of a discount here of about 3 points between the market cap weighted versus the equal weighted. And to those difference of the valuation and concentration risk, I try to have a bit of more insight about those elements with those three graphs. One of the things is when you look at your cycle adjusted price earning, which is often a measure to smooth out some of the cyclicality of the earning cycles of a country, we can see that the USA and the rest of the world, like a gap winded in the last few years, and you have now a 10-point discount between the two. So it's just it can sustain for a while or it can revert back. This is something I don't have much insight at the moment, but normally those things they kind of revert back most of the time. And on the graph in the middle is what's the weight of the largest 25 company in the index for the global, the MSCI World Market Cap Weighted Index. So as you can see that the largest 25 company, now it accounts for about 30% of the index. So a lot of your investment are going to the same names. And also again, on the graph on the right, as you may see, the valuation of those 25 companies, they are a lot more expensive than all the others companies. So it begs the question that if valuation spread comes down, should I choose a equal weighted benchmark or MSCI or a market cap weighted benchmark? So those type of questions of information are important to ask ourselves when selecting a benchmark. So I think here, if I go back to what we introduced earlier, it's all those steps brings you to, I need to have those information about selecting an exposure using those benchmarks. We can move to the next slide. Yeah, so in summary, I just mentioned about the benchmark as a standard for evaluation. The difference in type of benchmark are kind of important. Sometimes the performance difference can be substantial. At the moment, believe that the equal weighted benchmark, it offers some kind of differentiation versus the market cap one. And you see that some benchmark, they may have a concentration risk that emerge in them at the moment as well.
Perfect. Carl, I got a few questions about how to find these types of ETFs. So you know what, if you don't mind, I'd like to take maybe like 2 or 3 minutes to show the National Bank Direct Brokerage platform before we jump on to the next topic. Is that all right?
Yeah, perfect. That makes a lot of sense.
Perfect. So I'm just gonna share my screen now for for those of you who aren't National Bank Direct Brokerage clients, this is what our platform looks like. Again, if you don't already know, there's many advantages of dealing with us, but the one that that sticks out is that if you're looking to buy stocks or ETFs online, whether to buy or sell, we don't charge commission. So whether you're looking to buy a unit or a large amount, it's at zero. And so in terms of, we have an ETF center. So it's on the left-hand side under the markets heading, and it's called ETF Center. Now, whether you deal with us or with one of our competitors, pretty much everyone's going to have an ETF center with different filters. That said, you're going to have a hard time. There's certain standard filters, criteria, but I think you'd be hard pressed to find one for equal weight. So I'm going to show you a little trick for those of you who are clients of ours. Once you're in this section, you would go under ETF research, and you would click on ETF research and strategy. So this is as of August 2nd, so it's a little bit old, but it gets updated. So this is what the report looks like, and specifically, we are looking for one. It's called. Its last update was on April 9th. Honestly, they're due very soon to be updated, but it's called Exchange Trade Funds Canada and U.S. And what this document is essentially it's a snapshot as of April 9th of all the Canadian and US listed ETFs in obviously in Canada and in the States. And it's very straightforward, but you can, using the ever popular control find, you can look for equal weight. Generally speaking, if the ETF is equal weighted, it'll have the word equal weighted in its name. There are certain categories. You know what? I'll look in this. There's one here specifically. It's sector. I know it's not what we were talking about, but like there, if we go through this, you'll see certain where you'll see the word, you know, uh, equal weight, for example, equal weight. So these are for sector specific ones, but you'll certainly be able to find ones for U.S. and international. I think it's probably the easiest way to go around to get that information. So that's it for this. So I'll go back to the presentation, and Carl, I guess we'll move on to the next section.
Yeah, that's perfect.
Oh.
So I think the segue to this is, as I mentioned earlier, was to Evovest. What we do is we have systematized like the way to analyze stocks, and because international market there are many names. The way we do it is with a systematic process that use machine learning. So this is a solution that we develop. Here, it's mostly for informational purposes for you guys to look at. There are solutions out there that use like emerging technology. So this is mainly kind of an overview of this that we want to do quickly. So there's three things essentially. So what does it take? Introducing Eve. Eve, it's like the trademark process that we have for the investment process internally. It does learn something, which is what are the relationship between data and future excess return. So by looking at the data and using those technology, we will be able to have a sense of, are we able to select companies that will statistically do better over a long period of time than their peers. So this is what it does. And then using the last financial data, it will predict the next return phase. And thereafter, we use those predictions and say, I want to build a sound portfolio with a diversification and that doesn't have much sector exposure or concentration risk. So this is how we can do it with our investment process. A bit more detail, maybe on the page 25, is that approach to investment. So technically, when you look at it from a really technical perspective, so I'll go a bit technical and I'll come back for a few other slides. But what we want to do really is to predict correctly the excess return of a company. What does it mean? Excess return is like, remember earlier we had Apple that is in the S&P 500. So what we want to do is to say, what is the return difference between Apple and the S&P 500? And that difference is what we care about for us. So we try to predict that difference. So with the information we have at our disposal, is decoding that relationship between the data and that difference in return between Apple and the S&P 500. For that, we'll be using machine learning tools. So the main hypothesis we're working with is relative return can be explained by the information we do have, by using a scientific method, and doing so, what we want and how do we compare or evaluate ourselves is, am I able to take more informed decision most of the time and have a better probability of creating value versus my benchmark than my peers? So technically, like conceptually, this is what the approach and what drives our day-to-day research at Evovest. This is like the 10,000-foot view of the process. So we have the task at end, which is essentially combining those data with the future excess return and decoding that relationship. So what we do for the kind of input, the data that we have, it's everything that is technical indicators. We had macroeconomic factors and some financial ratio. After the investment process, the Eve, what it does, it will learn those patterns and those try to decode this. And after the output is, as I mentioned earlier, we try to predict the difference between Apple and the S&P 500. In that example, that prediction was 2%. So all of this process went to say, oh, we believe for the next week, the model believe that Apple will outperform the S&P 500 by 2%. So this is what it means. And one of the key things is using everything that is machine learning or AI is to make sure that you do understand what is behind those decisions. We've developed great tool for that internally that says, if you take a trade and decompose it into what was the driver behind that trade, we have this thing called expandable AI internally. And a key example is for a prediction that says, we think for the next week, Coinbase and Costco are going to do the same thing. They're going to be 1% above the S&P 500. But the reason for why they will be above the S&P 500, they can be completely different. In that case, it could be Coinbase could be really momentum, short-term signals, technicals indicator, volume anomaly. But on the other side, Costco was more about quality of the financial ratio, the risk of market perception, those type of things. This is also learned from a portfolio level, which is the bottom of that slide, which means on the portfolio construction, once Ukraine was invaded by Russia, there was a shift into how Eve made decision. It went from caring about everything that was related to earnings to a lot of stuff related to volatility and risk of market perception. So what I mean to introduce here is from a investment process, it's always good to have an auditing tool to understand a bit of the intricacy of how things work. So I think for us, it's a key aspect that we put forward in the last few years that enables us to have a great discussion with our institutional client. Or maybe the next slide. So just to a bit of a recap on this, the point to consider, there's tools out there that exist to help the investor make decision or to essentially you outsource the decision to machine. It helps discover the relationship between the returns and some of the factors or inputs that you put in, and sometimes it's a great tool for portfolio adaptability. So that's about my small introduction and recap to what we do at Evovest. I hope this was helpful.
And Carl, I imagine, I think, when we're talking last week, I think Jamie Dimon from JP Morgan had mentioned like they were working on their own AI too, and I think it's pretty much it's going to be I imagine it's something that industry wide they're either working on it or thinking about it. I imagine, right?
Oh yeah, and those methods, everything that is AI, it's a natural evolution of statistical learning that has been around for many years. The bigger hedge fund in the US, they had a lot of resources, supercomputers, so they've been using similar tools for a long time. But everything that is mostly generative AI that emerged in the last few years, those tools they can be really useful, but it's still within the name. There's generate. So it does generate things, and it's not a source of truth. So the key aspect of having those banks deploy those tools is to make sure that it's a source of truth, or there's a verification process within it. So I do believe that those tools that they are putting out, it's kind of a nice assistant. But everything that is a large language model, as ChatGPT and Claude AI, they might be some modeling bias into, let's say, the usefulness in the investment world out of those. So what's next was really that question about using ChatGPT, Claude AI for managing or asking question. One of the key thing here, it's now it's a tool that a lot of people have access through a web browser. What do I mean that what's next for this? It can be a great tool to build a process, to revise things, to generate ideas of how to evaluate a portfolio, that type of things. But I won't rely on those tools yet to blindly make them, oh, should I buy this stock or not? So just pay attention to those elements.
All right. You know what? Let's see if there are any questions come in. Carl, if you want to take a moment and just go through the questions, see if there's anything there that you'd be comfortable to look at. Obviously, here's our last page. If you'd like to visit Evovest website, it's over there. You know what? In the meantime, another question I got was in terms of being able to compare the different ETFs. So I'm going back to the NBDB website, and there's two spots. There's really, once you're in the ETF center, it's called ETF Compare. So you put in your ETF. Let's go for X. XIU, and that's so you could, again, choose any other type of ETF you want, and it's very straight. Here you're able to compare up to 4 different ETFs, and essentially the overview is just the main information, MER, management fee. There's the key quote info. So think of that as a little bit as a detailed quote on the ETF. But most clients care about these two sections here: performance and top 10 holdings. So performance, we go back up to 10 years. And again, you'd have them side by side, and you can even look at it graphically. So to see, where's that return, where's that 10-year return coming from? Was it just from the last 2-3 years, or has it been consistently outperforming? And lastly, this really goes back to what Carl was saying. So the XIU is a market weighted one, and you can see the largest one here is RBC. If we were to find an equal weighted one for the Canadian market, it'd be the most likely, it'd be the same, a lot of the same names, but obviously the weights would be a lot smaller. So in this case here, so the XIU is the 60 largest companies, and the top 10 are 43%. So this would be a lot smaller. So this is something just to keep in mind. And again, the easiest way is here, Markets, ETF Center, Compare, or if not, you can also find it under the toolbox, Compare tool. And this is also good for stocks. So you can compare 4 different stocks or 4 different mutual funds. It's really it's up to you. All right, since I'm not really getting questions coming in, so let's just maybe do a summary. So obviously Canada is 3% of the world market. So we're missing out on the other 97% if you're just sticking to home. And obviously for the benchmarks, and again, it's the goal here is just to take this into consideration. Some people might say, you know what, I'm happy going with market weight. Let's say you already hold individual stocks, and you already have a Meta stock. You already have Amazon in your portfolio. Then maybe an equal weight might make more sense because it wouldn't be as concentrated. So right, everyone's case is different. One of the things that really stuck to me is that with the equal weight benchmark, these small cap and mid cap stocks have a little more weight. For those of you who can't tell, the gray hair, I've been through a lot of markets ups and downs, and when I first started working in the industry, Nortel and BC were about 40%, 30-40% of the Canadian market. And when Nortel started dropping, it didn't matter what the other stocks were doing because its weight was so important. it was dragging everything else down. So in the case where you had a portfolio that was equal weighted, it would have made a difference.
Yeah, much different result in the S&P TSX equal weighted versus market cap weighted in that time frame.
That's it. We have a question here on do ETFs get affected by the U.S. dividend withholding tax? Well, it depends. If you're holding your dividend, your U.S. dividend in a registered account, so an RSP, a RIF account, then there wouldn't be the withholding tax because there's a tax treaty. Now, if you're holding it in, let's say, a TFSA, a cash account, or this is always this comes out regularly. If you're holding it in RESP, those are not. There's no tax treaty between Canada and the IRS, so there is a U.S. withholding tax. So that's something to keep in mind. Carl, anything else you'd like to say, like before we wrap it up?
Thanks for the time. Appreciate it, and yeah, it was great to be here today.
Perfect. So thank you very much, Carl, for your time, and thank you everyone for joining us. I hope you find it interesting, and obviously, if there's other webinars you'd like to sign up for, by all means, we're more than happy to have them. Thank you very much. Have a great day, everyone. Bye.